All right, hello, everyone. Welcome to today's market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith. Derrick is a professional trader with T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Sorry, it's Monday for me. I'm a little bit sleepy here, but all right, here's a look at Derrick's current positions as of 12:30 p.m. Eastern time today. So this is, you can see, lots of logs on today. We'll talk about everything he's been trading, why he's been trading it, and what he wants to trade in the days ahead. Our topic today is that the market slide is continuing, and it is definitely gaining some steam. Derrick, how's your Monday going so far today?
I'm down a good chunk of money today. As you just showed with the position disclosure, I am very long right now. All right, so we're getting a little bit of a pop right now as we're talking. I really like the dip buy right now. I'm just going to start by saying that. If you want, I can give a quick overview on things. If I could do the old share screen.
For sure. Hold on. Not letting me add yours. There we go. All right.
Cool. So we are extremely extended to the downside. I mean, this sell-off has been absolutely and utterly massive, fast, vicious. It's honestly everything that I expected. When the market was at highs and I was bearish and everybody was calling me crazy, I called for a bigger correction. I think I said a 5 to 12% correction. I'm not 100% sure where the SPYs are on a percentage basis right now. If I had to guess, they're probably like 7%. But the Qs are trading beyond a 10% correction now at this point. So the Qs are over 10%. But now we're starting to hit a point here where we are getting extremely extended to the downside. And as we get through this week, the flows potentially begin to change a little bit. January, first half of February, are historically seasonally the biggest inflows of the entire year. That typically gives way in the second half of February, where you typically see outflows. And it's not as simple. I wish it was. It's not as simple as just inflows means that the market's going to go up, and outflows means that the market's going to go down. And whatever the market does historically, it's most likely going to do again this time around. I wish it was that simple. It is definitely not. Sorry, I'm trading at the same time as we're talking because this market is moving so rapidly that it's hard to look away from these positions even for a moment, especially when I have this much on. But starting on historically March 14th is actually when the inflows begin to occur again. That is just like one data point amongst many important data points that traders need to be paying attention to right now, just from like a market dynamics perspective. This week, we are still seeing a lot of forced selling that's coming out from like the CTA trend following funds. They sold, per a note that I read this morning, $57 billion worth of SPX last week. They're set to sell another $39 billion worth of SPX this week. That's a huge headwind to this market still, especially at a time when we're trading in a negative gamma environment. So it just stretches the movements in both directions. And if you look at a lot of the other positioning flow from like hedge funds as an example, back at highs here, they were at their like 96th percentile of long exposure. For the most part, most of the data I'm seeing, whether it's like long short funds or whether it's from these CTAs or from various pockets of buyers in potential buyers in the market, they've washed out like some of their positioning that just more or less brings them back to neutral. So neutral means higher or lower still. They're just back to where they normally are, which means that they could sell or they could buy. And that's just from like extremely massively long positioning at the top. Like that was part of the problem with this breakout here on February 19th, is that there was almost no one left to buy. Everybody was fully in the pool. Retail was fully in the pool. Hedge funds were in the pool. Your systematic funds were completely in the pool. Volatility had come down. And now all we are back here is back to neutral. But we're also in an environment now where, I mean, we're not in a bear market, but I describe the environment that we're trading in as a bearish environment. What happens in bear environments, some of the biggest up moves in the history of the market actually occur in bear markets. If you remember that little bear market we had in 2022, was not a super deep bear market, but it was pretty long in duration, we had some incredibly large rips to the upside. So I'm not calling for like a bottom right now that leads to all-time highs, but I think that we're getting close. And today I might have jumped the gun. I mean, I did jump the gun. I was a little bit early and a little bit too aggressive on my buying today, because I think that we are starting to set up for a much bigger snapback rally in this market, but it's probably more like later this week or even as late as early next week. So, for now, we're obviously continuing to sell, but the degree of downside extension here is getting ridiculous. I mean, we're $15 off the 8 EMA right now in the SPYs. The spread between the 8 and 21 EMA is widening. The Qs are even more than that. We're like $19 downside extended from the 8 EMA in the Qs. And then again, the 8 and 21 EMA spread here is widening. We're starting to hit the point where we're due for a very, I think, hard, fast snapback to the upside. It's just, for the moment at least, that any snapback does run into a lot of forced selling, for example, from those CTAs. But we're just in an environment where selling feeds on itself and buying feeds on itself. So if and when we begin to see that bounce back happen, which I think is going to be relatively soon, especially the way that we're selling right now, I don't think can last. It's going to be a very heavy snapback rally. And now a lot of investors out there are really starting to get worried about the economy and everything, when they should have been dumping their stock back up a few weeks ago when I was calling for a near-term top. They're starting to puke their stock out down here. And I think that actually is further fuel for a bigger short-term bounce that's going to be coming in, again, later this week, maybe as late as early next week.
A lot of course, the sell-off, as you mentioned, is being prompted by the recession fears. Now at this point, it's just adding fuel to the fire that has already obviously been burning. When you look at the chart, Trump today saying, we're in a transition and you can't really watch the stock market. Is that a message to traders and investors that he just doesn't care what's happening on Wall Street and he's going to move forward with his economic plan, whether it hurts the market or not?
Yeah, I mean, that's definitely been the rhetoric that's been coming out of the administration for a while now, is that they don't really care about the economy or the market in the short run. I mean, there's a lot of smart people right now that are actually talking about a bigger picture plan that might be coming from this administration that is meant to actually bring us into a recession, because that recession can kind of give us an economic reset. So, it sounds crazy, and I definitely think it's a really dangerous game. But when I look at some of the stuff that's going on with the tariffs, it doesn't make any sense to me otherwise. I mean, this is basic economics. I've been saying this for years. I've been saying it all through the Biden administration, because I thought that the Biden administration should have pulled back on some of the tariffs that we currently had. I was saying it through Trump 1.0. I'm continuing to say it through Trump 2.0. Economics are, tariffs are bad economics. It's really as simple as that. If you want to point towards other benefits that might come from it, whether it's fentanyl coming across the border or things or national security, fine. I'm not a politician. That's not a discussion that I'm interested in being involved in, and maybe there are benefits there. But I'm just talking very strictly from the perspective of economics and from the perspective of the market. I mean, look what the market's doing. The market is doing this primarily because of tariff rhetoric. We have already created a market correction because of tariff rhetoric. So it's just bad economics. But the potential idea here is to basically maybe create a recession. And if we're in a recession, like at first, like kind of the level one thinking, and this is where my head was at, like at the end of 2024 and into the beginning of 2025, I was saying to myself, oh no, tariffs means higher inflation. And it's potentially all part of like Trump really pushing for growth. And it's like, all right, high inflation, high growth environment might be coming in right now. And then that's going to force the Fed to stay higher for longer. But now we've moved into kind of the level two thinking, which is these policies, while they are inflationary in nature, they might slow growth down so much that it actually counters the potential inflation that comes from things like tariffs. So I know you've got CPI on Wednesday. the market is becoming less concerned, and I don't even know how to read this CPI, by the way, because the market's becoming less concerned about inflation and more concerned about growth. So I really don't know what's best for the market on Wednesday. If we get a hot CPI, that actually might calm some fears down on slowing growth. If we get a weak CPI, and this is the opposite of what we had seen for years now, right? For years, if we had a hot CPI, the market would get smoked. If we had a weak CPI, then the market would go up. There's a chance now that the inflation numbers actually begin to have a read through to the market, the complete opposite of what we're used to, where high inflation is like, okay, growth is going to be okay, and the market gives us a really big snapback, whereas low inflation might actually contribute further to growth fears, which could continue to cause market weakness. So, there's almost some chatter that the idea here is if we can really slow the economy down, if we can create a negative wealth effect from selling off the market, from selling off cryptocurrency, if we can go into a recession, what happens in a recession is interest rates go down. And that could almost be like an economic reset, where then we can focus more on the private sector and on tax cuts for corporations and on growth through the private sector, as opposed to what we've been seeing for the last probably 15 years now, which is a lot of US growth coming from like the government and increases in government jobs and increases in government spending and an increase in deficit spending. It's a dangerous game. For the moment, the market hates it. So that's where we're at right now. But I do think at some point we're going to get a bigger bounce back here.
Mm-hmm. You answered an upcoming question of mine, is how the heck do we rate the CPI this week? Because it is definitely a weird CPI for this market, a totally different one, I think, than any we've had so far. Obviously stocks are down. We're definitely seeing a flee to safety in the bond market. If you look at the yields and how they're moving, for you, how do you look at the stock market and the bond market together? I know you trade mostly equities. You're not really trading bonds. But how do you use the two market environments together to get a read on the overall investor picture?
Yeah, so I'm constantly paying attention to the bond market, even though I basically never trade it. It's just really important if you're trading stocks to have an understanding of what's going on in the bond market. If you were to just like take a 100-year data set and try to figure out if interest rates going down means the stock market goes up or the stock market goes down, you're not going to be able to gain any information from that that's actually going to help you with your trading. And it's because the relationship between interest rates and the stock market is actually something that's constantly changing based on the current narrative of the environment. So in order to understand how interest rates are going to impact the equity market, you need to understand the environment that we're in. And this is actually one of my favorite parts about trading and markets and about this business, generally speaking, is that the environment is constantly changing. You need to be constantly learning. You need to keep your ear to the ground to know exactly what's going on. Similar to what we were just describing with the inflation, with CPI, where we've just been in an environment for a few years now where higher inflation meant lower stocks. And now that narrative might actually be flipping to higher inflation is a relief on the growth scare that actually it benefits stocks. And when it comes to interest rates, it's a similar idea where the impact of the move on interest rates on the stock market changes based on the broader narrative. So the last couple of years, as inflation was coming down, it was giving room for the Fed to be able to lower interest rates. So as we saw inflation go down, growth was staying strong, and you would see that interest rates would be going down as well, and that the like a TLT would continue to work its way up. Now that's it's switched again. Now we're seeing the TLT move higher and interest rates go lower, not because of CPI, but because of growth. So it's the same thing. It's the same concept. It's just a different way to be able to look at it. So now when you're seeing the TLT move higher, which means that interest rates are moving lower, it's less to do with, like inflation's coming back down to the Fed's target of 2%. So interest rates can go lower. Now it's more like this is a flight to safety. the stock market's going to get destroyed because we might be going into a recession, and because growth is slowing down, I don't want to own stocks right now because they're a risky asset. I want to be able to have cash. I want to be able to have bonds. So now what we're seeing is the bond market is moving again more based on these growth scares. It's moving up as a safety trade, which means that interest rates are going down. But whereas a year ago, interest rates going down meant the stock market was going up, now interest rates going down means that the stock market's going down. So that's another narrative that has really changed here in the last month or two. That's primarily based on the policies of the current administration.
Real quick, Derek, shut down your screen. I'm going to take down your screen share. We're having just a little bit of like video connection issues. Yeah, just so your internet's not having to do all of that at once, because I know you're trading too. Okay, you're not an investor, you are a trader. So this market environment definitely has been a bit scarier for some, the long-term investors who are the buy and hold people who, may have bought at the highs and they're like watching their investments just go down, down, down. But you are a trader. So how has this environment been beneficial for someone like you? The volatility we've been seeing is definitely, today we've already discussed, maybe you're a little ahead of the curve on the long side. But if you look back at the past, what has it been? 10 down sessions in a row. I forgot what we were looking at your chart, how many, but lots of down sessions in a row, but that's also come with lots of volatility. How has it been a good environment for you as a trader?
So overall, this environment has been awesome for us. Awesome for us. We called the top. It was net short at the top. We called that big pullback. But also, up until today, I actually feel like today is the worst that I've traded in a while, and I jumped the gun and I was too aggressive too early. We have nailed every bounce back when the market has gotten extremely extended. We called out for longs near lows on February 25th. It was a great trade. We called out for a long near lows on February 28th. It was a great trade. We called out for long near lows on March 4th. It was a great trade. We called out for long near lows on Friday. It was a great trade. So this environment for me strategically has been about aggressively shorting these bounce backs, much more aggressive than I typically do, and actually being very, very patient primarily on the long trade, where the normal degrees of downside extension that I would look to buy this market has not been enough. And I've been, to give myself some credit, doing a really, really good job just being patient and patient and patient. And it's like, all right, normally we're like $10, $11, $12 away from the 80 MA and the SPYs on the daily chart. This is where I would begin to do some counter trend buying. I've been waiting for $14 to $19 of extension on the downside to come in and do that buying. And up until today, I've made money on like every shorter term day trade or like 2-day swing trade that I put on the long side of this market. So this volatility, these huge movements, they create a tremendous amount of opportunity for traders. It's a higher risk, higher reward environment, but we can be long into that extreme downside extension. We can short bounce backs in bear markets, and it's just a great time to be a trader. Not a great time to be an investor, a great time to be a trader.
Yeah, definitely. Volatility definitely creates a lot more opportunity. You already talked about the CPI on Wednesday. We're going to get the CPI Wednesday, the PPI Thursday. These are typically important numbers for the market, but definitely a different backdrop of interpretation this week compared to any CPI we've seen in the past 2-3 years at this point. This CPI comes a week ahead of the next Fed meeting. So the Fed, I think, is in their blackout period pre-meeting all week. So we're not going to hear from any Fed officials. So we don't even get a read on how they're feeling about this CPI this week. Are you expecting more good trading opportunities to come from this economic data? Even if, of course, the market might go down, the market might go up, but just more trading opportunities because of the volatility.
Yeah, for sure. There's so much uncertainty out there right now, and uncertainty creates volatility. It creates the big movements, and we could see huge relief rallies if any of these economic numbers come in better than expected. We could see a big continuation of the downside if they come out worse than expected. Then we'll see what the Fed does. I think that the Fed's going to do nothing. I think that they're still going to just be in pause mode. I don't think that the Fed can continue to cut right now until they get better clarity that inflation is continuing to move to the downside. There's just too much uncertainty for them to cut right now. And yeah, sure, I'm sure that they're looking at the stock market, but we're not down 25%, at least not yet. We're down 5 to 10%. It's not enough for the Fed to come out and start doing emergency cuts to boost the economy and boost the stock market, especially if there is a fear of reinvigorating inflation. So I think that the Fed is still just going to kind of be in wait and see mode. It'll be interesting to see what language comes from them, and it'll be interesting to see what happens with CPI and PPI. In particular, how the market reacts to what the numbers are. If the numbers themselves are going to be interesting, it's going to be even more interesting to see how the market reacts to what those numbers look like.
All right, I want to get some of your ideas. So maybe let's bring your charts back up and look at some charts with you, see what setups you're liking and what you're interested in. We know you're hoping for a bounce here in this market. Might be a little early, maybe not. Day's not over, week's not over. You never know. But if you can put your charts back up, we can maybe look at some charts together and talk about what the setups you like as a trader are. This is your personal opinion, of course. No suggestions for anyone to take a trade, but
sure.
What is Derrick liking?
So this degree of downside extension, momentum is a hell of a thing. It could bring us lower. It can make us more extended. I mean, that's literally what momentum does, is it makes an extended market become even more extended. A market can remain irrational for longer than you can remain solvent, all that really good stuff. But this degree of downside extension this fast, like I said, there's still a bunch of headwinds this week, but we're starting to get close to the point where I think that we're going to get a much bigger snapback for the market. And originally I was thinking it probably would come in like the second half of this week through the beginning of next week, but seeing the continuation of the downside acceleration that we're getting right now, I actually think that we're getting, it might even actually push forward the timeline of when that vicious snapback occurs. So that's what I'm looking for. And I'm looking for a snapback that exceeds the ADMA actually. Like the ADMA on the daily chart for whatever stock you're looking at or for the market, I think is like a great target one if you want to start building into some longs here. But I'm actually looking for a little bit deeper than that. I'm looking for a bounce back to like the space between the 8 and 21 EMA. So if that were to start today, let's just say, and I'm not sure that it will, but if it were to start today, I'd be looking for a snapback in the SPYs to somewhere between like 580 and 585. Obviously, I am constantly adjusting my thought process on targets and things like that as the picture evolves over time. So what I'm saying today, if the snapback rally doesn't start until Wednesday, I might have a much lower target on that. But if it were to start now, I think we could see a vicious rally back to 580 to 585, and then things will get a little bit trickier in that area, and we'll kind of take it from there. When you're in a bearish environment, and again, we're not in a bear market, so I just want to say, I'm not saying we're in a bear market, I'm saying we're in a bearish environment with how fast we've been moving to the downside, correlations increase. So in this type of environment, everything starts with the index. It's very different than when we were trading in like really for November, December, January, and the first half of February. We were primarily very range bound. We were in an environment of dispersion. It was a stock pickers market. There were winners and there were losers. And the indexes didn't matter as much because you were primarily moving sideways and you wanted to figure out where the relative strength was and go long the strength, go short the weakness. This environment has changed. This is an environment of increased correlations. If you're thinking about buying any of the Mag 7 stocks, you need to have a close eye on what the indexes are doing at that point in time, or really any other stock or any other sector. So it starts with the market. And I'm looking for the snapback to begin to come in at this point. There's a lot of things that you could potentially target on that trade. I like Google. I like AVGO after that earnings report. I bought some Meta today that I like for snapback. I mean, this Meta, does anyone remember when this Meta had like 23 green days in a row and it was unprecedented? And by the way, this is another move that we shorted into. I caught a move down to, I think, 660 or so. Thought I had this incredible trade. And now here we are, $70 lower than that, coming into huge support on Meta with extreme downside extension in the company that had the best earnings report at any of the Mag 7 stocks. So I bought some Meta today. I like this NVIDIA. I've been eyeing like the 107 area on the downside in NVIDIA for like several days. We got down there a little bit on Friday. We really got down there today. I bought some NVIDIA today. I bought some of this SOXL today. This is a little bit of a tighter trade that I have on because I already have AVGO and I already have NVIDIA at the same time. A little bit outside the box, but this VKTX has been one of my favorite names to be involved in. I think it's my biggest position. I really like how well it's held in these last few days, but it needs to clear through $29.50 to $30 in order to confirm it. So I'm probably jumping the gun a little bit on being long and being long as heavy as I am. But if this thing can clear through 30 with the relative strength it's shown in the last few days, if it can get some market help, I think you could actually very quickly see a move in this thing to $40 plus. If you could get any market help, which definitely is a huge if. I still like these energy names, though XLE, I didn't like how this broke down through 91, but I like the drillers. I have a pretty big position in this VAL. This VAL is, I don't love a new buy here, but this VAL really finally gave some downside capitulation on very high volume at this absolute low a few trading sessions ago. So I like the idea of having some degree of diversity. I like the financials a little bit in this area also, now that it kind of filled this gap for a little bit of a dip buy. That's an area I don't have direct exposure to any of the traditional banks. I do have a position right now in SoFi, which is breaking back down and extending back down. I do have a position in PayPal, which has gotten really beaten up over the course of the last month and a half. So I like the idea of, first of all, paying attention to the indexes, and then as you're breaking down what you want to be involved in for a potential bigger bounce back, having some degree of, honestly, diversification in the types of symbols that you're buying, because even though correlations have increased because we've been in a down market, some things will bounce better than others. So I think it makes sense to have some Mag 7, some growth, some financials, some energy, and we'll see when, if, and how we actually get that broader market bounce back that could obviously help these stocks bounce back as well.
What are the sectors you're looking at for your first signals that a broader market bounce back would be coming?
I'm looking at the indexes. It's not really sector specific for me. I mean, a little bit these Mag 7 names, just because their weights are so heavy. Microsoft made a new low. Microsoft's another one that I kind of like here, but I don't actually have a position in it. So I'm heavily watching these Mag 7 stocks. Not so much Apple. Apple's interesting because Apple almost trades like a safety trade sometimes.
I would say Apple's like a weird safety trade. Like, you can't look at it. Yeah.
Yeah. So and Apple's insanely weak today. I mean, Apple's off 5.6%. But I actually think that Apple selling as hard as it is today is actually an additional signal that we're actually getting closer to seeing some sort of bigger bounce come in on these indexes soon.
I mean, the mantra used to be buy every dip in 2021 and 2020. But that mindset, of course, has definitely changed. You can see we just keep dipping. I mean, that's an ugly chart on the Qs for sure. Like, that is not a fun chart, but could be a good opportunity for a bounce. We've seen some crazy, I mean, Friday, if I think about Friday, that was a day.
Friday was nuts. Friday was an insane intraday reversal. And there's another one that we were buying by being patient and waiting for that extreme downside extension, similar to what we have now. This market just really struggling to pick its head up. Look at this. We kind of have, just looking at the chart right now as I'm talking to you, we have this interesting descending wedge here that's built out intraday. This is technically a bearish pattern, but I think that when you have as much extension on the daily chart as we have, these bearish patterns have a much higher probability of breaking up. So if we can actually start to get the Qs, is what I have up right now, above like 476.50 in intraday here, that actually could be a catalyst for a similar pretty big intraday reversal to what we saw on Friday. But for the moment, we've been very, very heavy today.
Yeah. All right. Derrick is a real trader, and I know he's itching for me to let him go so he can manage all of those positions he has. So go to t3live.com/DOLive if you'd like to get Derrick's free ebook about prop trading and the benefits of prop trading. If you work with T3 Trading Group, you work directly with Derrick Oldensmith himself. And he's the head trader there over at T3 Trading Group, and again, the leader of T3 Live's Pro Desk virtual trading floor. Derrick, good luck in the market. Good luck with the CPI and the PPI this week, and we'll talk next week ahead of the Fed. So it should be a good one.
Thanks, Retta. See you next time.
All right.